Now joining us on set is Malayan Traders Capital founder and chief investment officer Devan Rajadurai.
Now we understand that they have over 25 million ringgit in assets under management (AUM), and they are applying their hedge fund strategy right here in Malaysia.
So you've only just recently got your license to operate in Malaysia, and this has not been a market that you've traditionally been attracted to, but you're seeing the opportunity now.
Yes, I mean, if you look at the ringgit has declined significantly, and if you look at the share prices in Malaysia compared to last year, it's declined considerably too. So we see a lot of value in Malaysia. In fact, for the first time this year, we have invested in Malaysia. But not just Malaysia in general, we see that in Southeast Asia. But in Malaysia in particular, we're seeing the value emerge.
I see that you've invested into Coastal Contract. Now that being an oil and gas play, why are you feeling confident about this stock?
So our strategy of our fund is that of value investing. So whenever we see a good solid company, share price retreating significantly and then a value emerges, then we will start looking into it. So yes, in oil and gas, things are looking very bad. But in the Coastal Contracts case, they're one of a company who is very well run and they have a lot of cash on their balance sheet. And basically they're trading below both their cash and their inventory, which is ships, solid assets. So we see a lot of value there.
Now, but as a whole, have we already seen the bottoming out in oil prices, you think?
We don't predict all prices, but all we can say is that it's quite low, and we think that some companies are probably going to suffer, and some companies has over leveraged and probably been mismanaged. Some may be on the verge of bankruptcy, but there are going to be a few players out there that are going to be showing extreme value.
Can you name them?
Coastal Contracts is one of them, but we don't name too much stocks. But we can look at not just oil and gas, you can look at plantations also.
Let's take a look at the themes around oil and gas, because we recently spoke to Frost, for example, who said upstream is going to see 30% spending cuts in 2016. Downstream is going to be looking more interesting. Oil storage capacity in particular. So what themes are you then looking to play on?
We generally don't, we're not looking at a specific theme, whether it's upstream, downstream, but generally if I have to take it away from oil and gas, generally we prefer upstream players because they own the assets at the end of the day. So if anything goes wrong in the case of plantation, they own the land. So if anything goes wrong, at least they got the land. And if you've seen some palm oil players or plantation players in Malaysia in particular, they converted that into property so they can extract the value there.
Okay, and then, well, speaking about land, then recently you're seeing Felda, for example, trying to expand their land bank there in Indonesia. But certainly, given the dynamics of the market right now, it's making these kind of deals very, very tough. So what kind of opportunities are you seeing in the plantation space? Can you name some counters?
One company we like is Wilmar. And we like Wilmar because it's a very well-run company and it's been operating for more than 30 years. And they have shown ability to manage their assets very well, even in the downturn and upturn. So when they retreated from sugar in Malaysia a couple of years back, they decided to buy sugar plantations in Australia. And now they're deciding to expand their operations in Africa with palm oil. So they have managed all their assets very well, and we feel they are like a well-managed company. And as you can see, all plantation companies are trading at a very low price these days.
This week we do have the Fed decision. Most traders are betting that they will move in a post-Fed hike era. What would that mean then for your positioning, as you know, we do see the interest rate environment perhaps get pushed up?
Yeah, so the thing with the Fed, a lot of people are very fearful due to the uncertainty, so they're not sure whether interest rates are going to go up and come down, and there are certain economic ramifications as it. We don't see it as a bad sign, because if the interest rate is going up, that actually is a sign by the Fed that the US economy is doing well. And so, depending on the economists may have a different view. We think it's actually a good thing if they put the interest rates up. And at the end of the day, for a lot of companies out there, if it's not cyclical, it just shows that the company is doing the economy is doing well. So those companies will naturally grow as a result.
And what does that mean for your strategy? Because you're primarily exposed to global blue chips, for example.
Yes. So for our strategy, because we are global blue chips, the Fed decision has a minor impact on the overall portfolio. At the end of the day, the companies that we invest in are companies that can withstand cyclical natures like commodity prices or downturns. So a company like Apple, for example, regardless whether interest rates are up or down, or whether food prices are like really cheap, they will always sell their iPhones. So that's the companies we look at.
Now, MTC is a value investor, and you also have a longer term view, 3 to 5 years. But 15% return, how are you going to generate that?
Yeah, so one of our key strategies that we do is that we will invest in blue chip companies and we will apply some leverage. Like we will take USD loans that, as you said, the interest rates are so low, so it's less than 1%. And as a result, Sing dollar loans are so we will take those loans and we will buy into these solid blue chip companies, which we feel it's a very low risk strategy compared to even some people who will buy a small cap company that stock prices fluctuate up and down.
But then on one hand, you claim to be able to promise these absolute returns for your clients. But then, for example, you got Nomura saying that 2016 it's going to be even more volatile. So what are you seeing that perhaps other economists are not seeing?
The main thing that the difference with us is we really look at it at long term. So we admit in the next for the end of this year, it's going to be a volatile year. Next year, the value is already out there. You can see it. Everything is low. We're not sure when it's going to pick up, but if it does pick up next year, when the pickup comes up, it's going to be very steep upwards. But we are willing to hold on to our investments for 3 to 5 years.
Now, it also seems that carry trade is a big part of your strategy as well. But then, again, given that volatile, the expected volatility, rather, I should say, how do you think that strategy would still be able to work next year?
Yes, it would, because it all comes down to you applying the strategy when there's everything is cheap. If we were to apply leverage, like let's say last year, especially in the oil and gas sector in Malaysia, where things were very pricey, that's why we never bought anything in Malaysia and oil and gas, for example. But now things are cheap. And if you're buying a good company that has a lot of cash and good assets, and they own the assets, you can see it, then even with that minor volatility, you can withstand it in the medium term. It's just the short-term declines. Yeah.
All right, we're going to have to check in with you then in a couple of months to see how your portfolio is going here in Malaysia.
Yes.
Thanks so much, Devon, for your time.
Thanks
that
a lot.
was Devon Rajadurai, founder and chief investment officer at Malayan Traders Capital.